has to go where? Back to a discount for smart money to go back in, trading back below the high and even below this high here to a point of a bullish order block and a discount. What's the discount range? Just the low to the highest high. It trades down, picks up more orders. Too late in the day to do much about that. Start a new day, and then it rallies up into the fair value gap here. When it has this signature in price, we have a fair value gap, higher high relative to the one to the left. In other words, we have relative equal highs, but it makes a higher high on the second one. That is going to be a formidable high. In other words, expect this type of event where it'll trade up into the fair value gap, and then it may not trade through these. It may need to retrace back down. Whereas you don't need to see that happen in the euro, because the euro didn't move to such a degree that it was at a very high premium. It just went above a previous high, shallow, and then retraced back down to a bullish order block, optimal trade entry, and it runs. This shallow run above the old high here is much less than all of this price action above here. So when we ran above, it was much more distance covered. Many more pips were taken in the Australian dollar into a premium level, causing it to need to move to a discount much more than that of the euro. So understanding that this fair value gap here, and I'll take this off now so you can see it. The fair value gap is where it trades up into. Then it needs to retrace back down. It could have ran through, but the chances of it doing that are diminished if we have this higher high and we run above old highs like this. And if it was a very shallow little run and it had a fair value gap in the high there, then it wouldn't make a big deal. It wouldn't be a factor. There's specific things I'm trying to communicate here that it's going to take a little bit of thought on your part, but as you go through your charts and you look at this happening, you'll quickly see right away that what I'm showing you is whenever you have the higher high, even if they're relative equal highs, if there's a fair value gap in there and we've taken out previous highs and it's been done in a manner like this where we moved a great deal in terms of pips versus the euro dollar where it hasn't really moved that much. It just was a small little shallow run, trades back down, picks up more orders, and then explodes to the upside. Whenever you have relative equal highs and the higher highs on the right and you have a fair value gap and you've already moved above previous high a great deal, it's going to want to retrace deeper than running quickly above the equal highs. Okay, so I'll show you the E-mini S&P and you'll see that is another example of what I'm showing you here. But how do you look at price to see this? How do you study it? Go through your hourly charts, go through your 15-minute charts, and you'll see lots of examples of that over a span of 4 weeks. Okay, so 1 month, 20 trading days. Use your 15-minute chart and your hourly chart, and you'll study all of these types of signatures, and you'll see right away what I'm showing you here is not just one little cherry-picked idea, okay? Because every time I tell you something in the marketplace, for instance, like the fair value gap and or the consequent encroachment of these gaps or a volume imbalance, these signatures, the things I tell you about them, you are seeing, since I've taught you, you can see those signatures are in fact true. They're not contrived. They're not just built on, fluff. They're real things that occur. And what I'm showing you here is one of those events where I get a lot of questions about, like, how do you know when a high is going to hold and it's a turtle soup? If you are in a bearish environment, okay, in other words, if you thought that this market was in fact bearish and this event took place just like this, this would be a sell and get short when it goes up there and know with a great deal of confidence that this high would not be taken out, and then you could ride it for a longer term degree lower. But in this current environment where the dollar is weaker, this is setting up a stage that it wants to eventually go above these equal highs, but it doesn't need to do it the day it trades up to here. expect some measure of retracement, which was along the narrative of me kind of asking you before all of this is even happening, what's more important, getting paid or your target? So everyone knows when I prompted them to look at the 60-minute chart that they had relative equal highs. But how many of you were noticing this fair value gap? Chances are probably not a lot of you, because you were all being primed for me to look at these equal highs with you and see them ran out. Euro had no problem trading higher on the 28th. On the 28th of May, the Aussie dollar did trade up, but it went right to the fair value gap, stopped dead in its tracks, and then had a deep retracement. Didn't unsettle the idea of running those equal highs. It just was met with more resistance, but still nonetheless going and eventually running it out. And I'll show you that did in fact happen. Right there. So we ran that, and then we had a retracement. Now, what does that mean? What does that mean for you, and why is it important? Well, there's going to be times when you think you see a relatively easy, low resistance liquidity run. But if you are looking at how the market structure has been broken and how it's traded above recent highs, how much of a move above that did we have? This was pretty significant. And then you contrast that with a correlated pair, because the euro dollar should go up when Aussie dollar goes up. We only had a shallow run here. And then it comes back down. It goes back above and creates another optimal trade entry here, bullish order block. So you have two areas of accumulation. This trade is going to be more dynamic to the upside versus this trade requiring a little bit more time, and it's going to lag. It still can move in sympathy with a weaker dollar, stronger foreign currency, but it just means that it's going to be met with a little bit more time requirement versus that of a market like the euro has the underlying relative strength to the upside. So again, the signature is this. A lower high on the right, when you have relative equal highs, that's the ideal low resistance liquidity run. It's going to be real easy for it to run that. A higher high to the right, when you have relative equal highs, that's going to be a little bit more energy, okay, or magnitude on the part of the market to get through those, especially if we've already moved a degree into a premium. So we're really above these highs already, and we had a sharp retracement. Then we can look at this. Is there any fair value gap in there? If it is, and we rally back up into that, be expecting that to offer some kind of tradable retracement. And what is a tradable retracement? When we traded back up into this fair value gap, don't just look at it as it's going to come back down and find some kind of a fair value gap in here. Not that there is one in this price action, but it's going to require a deeper retracement. And how do we do that? Well, we have the range low to the high that's created. 50% of that is where you're going to have equilibrium, and below that would be a discount. So you have to look at all your discount PD arrays in here to align with what would likely be a scenario where it could trade back down into before eventually running these highs. Whereas you don't have that problem or conundrum with the euro, because you had a shallow run here and it retraces. So you know what's likely to happen. A deeper run above this high and above the original high that we would expect buy-side liquidity pool to be traded into and probed for the counterparty, because smart money has accumulated longs down here and down here. So where do they want to take their profits at? Above old highs, where there's going to be willing buyers to be counterparty to sell their longs to. And they only were able to get out here. So when it trades back down and rallies back above, they were distributing again. And when it came down again, started rallying hard, they were distributing it as well, as we were trading above this high in layered buy-side liquidity. For anyone that was going short here, their buy stops are all layered in here. Anyone that looked at that high as a buying breakout, the smart money can sell to those buyers on a breakout from the positions they took here, here, and here. And now in the optimal trade entry here and here, they could distribute those longs to the willing buyers on a breakout or protective buy stops above these highs. So when I look at charts and I'm looking for scenarios where I'm looking for a low resistance liquidity run, I take a lot of effort to to see where are we at in regards to the previous highs, how we broke that market structure to the left. So we have a higher high here, shallow run here. So it's due for a more pronounced run higher. The Aussie dollar, we ran above these relative equal highs, and we moved a great deal in relationship to that of the euro. And we had a deep, sharp retracement. Then we found another opportunity to go long in here, and then the higher high here is a factor that we have to overcome. Now, it doesn't mean that it's always going to create an opportunity where it's hitting this fair value gap or a fair value gap in this leg right before the high, and then it creates a retracement. Sometimes it'll be just a small little retracement, and then the very same day still run back up. But if you're not expecting that, it could be unsettling, especially if you're watching on a 5-minute chart or a 1-minute chart. It could scare you because those charts will look fast. They'll look like they're moving a great deal and change your opinion when it really hasn't changed at all in an hourly or a daily chart. Okay, so I just want to, everything I said here can be reversed for when we have equal lows or relative equal lows. Whenever you see lows like this, like relative equal lows, but this low is lower than the one to the left. So that same scenario here is what's being described here, just on the low end. So if you're looking for a low resistance liquidity run to the downside, and if there was a fair value gap, which doesn't have one here, this same element of trading back to the relative equal highs, but the higher high, if we have a fair value gap, expect it to trade into that and maybe have a deeper retracement before running the equal highs out. That said, in the opposite terms, for when you're looking for a low resistance liquidity run on the downside, the lower low here is problematic, okay, in the sense that we may need to trade down into some kind of a fair value gap if it resides there, and then retrace a little bit deeper and then sell off at a later time below that low. So it's important to know that while it may not be this big of a deal in the trade, even though you do see that relatively high